Thank you very much, everyone, for joining us today. It seems like most of the people that we've got joining us today are Crunch Limited company clients, but I believe we've also got a number of Crunch Sole Trader clients today, and also I think some Crunch Free members and Crunch Chorus members. So you're all very welcome. So just a quick introduction. I'm Jake Smith. I'm our content and communications manager. So myself and my team look after all our web pages, all the knowledge articles, and all of the emails that we send out to you. Hopefully they're useful. Michael Awuye is our expert today. He is our technical senior accountant at Crunch, and it's his responsibility to keep on top of everything at HMRC and help us make sense of it all for you. So I just wanted to cover off what we're covering today. We're going to quickly look at the COVID support updates that were announced in the recent budget. We're going to look at what action you need to take before the 5th of April 2021, so before the end of the tax year. We're going to split that out predominantly in the actions that limited company directors need to take, but also some stuff for sole traders. We're then going to look at some of the other action that you need to take and allowances that you need to make the most of. And then we'll move on to what the changes are for 2021-22, how they affect limited companies and sole traders, some of the other highlights from the budget, and then there'll be an opportunity to ask any questions. If you have got questions, there should be a questions box that you can see. You can put them in there. I will try to keep an eye on them as we're going through. If they seem particularly appropriate, I will try and ask the question during the slide, but we've got quite a lot to get through today. We normally do have a lot of questions, so probably most of the questions we'll save to the end, and if there isn't any time to get to everything in our session today, then we'll make sure that we follow up with everyone. And after the event, we'll definitely share the slides and links and Q&A. So hopefully we'll have you covered. And I think we might even try a little poll as we're going through today, just to be a bit more interactive with you. So as I said, we've got an awful lot to get through. Let's just get straight on. So first of all, COVID support updates. So we did just before Christmas, I think Michael and I did a session on the government COVID support. So I'm not covering everything in massive detail today, but there have been updates announced to both the CJRS furlough scheme and also the self-employment scheme. We've got slides on those two, just on the changes coming up. But the other changes that are important is the extension of the 5% VAT rate for tourism and hospitality. Even if you're not a tourism and hospitality business, you'll be paying less VAT if you use any of those business services. They've announced a VAT deferral repayment scheme, and there are also other tax deferrals, so self-assessment and time to pay and things like that. Michael, did you want to talk about those a little bit just now?
I think we've obviously got slides for it later on. Anyway, I could cover it anyway. For the deferrals, I guess for the self-employed, if you filed your self-assessment and your tax bill is less than 30,000, you could basically spread the payments, but you obviously need to speak to HMRC. I think there was a deadline for it, so it's quite urgent to speak to them quickly. And then once they have a payments plan in place, you should be okay. If your tax bill is more than 30,000, although you might be over that limit, you still need to give them a call if you're struggling to pay. Obviously, it's COVID and times are a bit hard for everyone, so they would make provisions for that.
And then on the VAT deferral, I think we've got that covered in a later slide. The government have announced a new restart grant scheme for businesses. We're going to cover that briefly. There's also a recovery loan scheme, which is going to replace the existing loan scheme. So that is the bounce back loans and the CBILS loans. They're coming to an end at the end of March 21, and the new recovery loan scheme will replace that. That's going to launch apparently from the 6th of April. The government also announced that they'd be extending the universal credit £20 uplift for a further 6 months, and that if you were claiming working tax credits, you'd also receive a £500 payment in order to sort of make up for that universal credit thing, to match the universal credit. Then if you're a business that pays business rates, important news is that they are a 3-month extension to the business rates holiday for businesses, and then also reduced rates once the holiday ends. So there's, I know that there's not hundreds of our clients that have business rates, but if you do, there is support there. As always, all of our information is on our COVID-19 hub in the knowledge section of our website, and your client managers can always help you with all this information too. So just very briefly, wanted to touch on the changes to the furlough scheme. So this is one that is available if you have any employees, or if you're a limited company director and you want or need to furlough yourself. So the scheme has been extended out to the end of September 2021, with 80% support available for employees. The support is still going to be capped at 2,500. Employers will still need to pay any employer's national insurance or auto-enrolment pension contributions towards the hours that are not worked. And importantly, a little bit like they did earlier in the year, the government are planning to ask employers to start to contribute towards the cost of the furlough scheme. So they'll need to pay 10% from July 21 onwards, and then 20% in both August and September. As we said, directors can make claims on the scheme, but there's still no cover announced for dividends. So, yeah, in terms of most directors take most of their income through dividends, so the scheme is not as attractive as they might have wanted it to be for them, I'm afraid. Still need to submit your claims monthly, and all of the details are in our article on the Coronavirus Job Retention Scheme. Michael, do you have anything to add on that slide?
No.
No, okay. And then again, for self-employed grants, slightly wider ranging changes here, really. So they've announced that there will be 2 further grants. I think we already knew that there were likely to be grants 4 and 5, but they have confirmed them now. There'll be a grant in April. They're just saying late April. They haven't given us an exact date yet for a 4th grant. And then there will be a 5th grant later in the summer, probably likely to be late July. The big change is the way they will calculate how much you might get and who's able to apply for it. So the grants may be higher or lower than your previous grants if you've got a previous grant, because they're taking into account the 2019-20 tax year. That does mean that, according to the government, up to 600,000 more people may be able to claim for grants 4 and 5, but it may impact the amount you get, because they're taking the 2019-20 tax year into account as well. So that is the self-assessment that you should have filed in January 2020. The 4th grant is going to be 80% of 3-month average trading profits, paid out in a single instalment and capped at 7,500. Then the 5th grant, slightly more complicated. It will be again, 80% of 3 months average trading profits, capped at 7,500 for those with a turnover reduction of 30% or more. We haven't got the exact details on how that'll work, but effectively they're starting to taper the support. So for the 5th grant, if your business has been more affected, you'll get the full grant. So if your profits have reduced by 30% or more, then you should get a full grant of capped at 7,500. If your business profits have been affected by less than 30%, then the cap will be reduced significantly down to 2,850. Our self-employed income support article has got all of the information on that for you. So what we'll do is we'll quickly move on to preparing for the end of the 2021 tax year. So actually, first I just wanted to do a quick poll before we do move on to those things. just to see whether the people that are on this webinar, have you actually taken advantage of any of the government support yet? So just a quick multiple choice question, see whether you've used the CJRS, the SEIS, one of the loan schemes, or any other form of support. I'm just always interested to see how many of our clients are actually using these schemes at the moment. Okay, I'll just keep it open for a few more seconds. So I've had most of your votes are in, so let's have a look. Okay, so this is telling me that 17% of the people on the call have used the CJRS scheme, 3% have used the self-employed scheme, 5% have taken out a bounce back loan. No one seems to have taken any of the other support options, and nearly 80% of you have not taken any support. So hopefully that is because you haven't needed it rather than because you couldn't get it. I do hope that you've been able to get support if you needed it. But let's move on. So we've split this section out into limited companies and sole traders because it's quite different what you need to do. So, Michael, I don't know if you want to take this one for us.
Yes, as the 2021 tax year comes to an end, you need to take the recommended salaries. That's if you are a branch client. Now, the recommended salary is the 8,788. That's pegged at the NI threshold. And then take the remainder in terms of dividends. Now, when you do a combination of these two, we are estimating that your tax bill will be around 2,662.50. Now, even if you are a Scottish resident and then you are still taking the same income, that's salary and then dividends, you should also be having the same tax bill. Now, the difference in the Scottish rates basically comes in when you take more salary than the NI threshold, because Scotland has got different tax bands anyway. Assuming you have no other income, then you should be fine in terms of just having this tax bill. The only thing you need to factor in would be the payments on account. Now, you need to know that for those who are new to payments on account, it's basically pay the following tax year's bill early. So if your tax bill is, let's just say, the 2,662.50, you'll be expected to pay a second lot of the 2,662.50 for the following tax year, because the government assumes you'll be earning the same amount of income and you'll be having the same tax bill. And there are two payments made. One half of it will be added to your January payment, and then the other one will be in July. Now, in terms of our clients, I believe we've got 4 groups of clients. You'll be having those who'll be taking their recurring salary, and then those who'll be taking, other manual salary, and the rest lower than the NI threshold and the rest. But we'll discuss that one on the next slide.
Okay, great. Yeah, so this slide is basically showing you how much you can issue to keep yourself within the basic rate tax bracket as salary and dividends, and the most tax efficient way to do that. And we've got a breakdown here of how that 41212, so that's the dividend amount on top of your salary. So it shows that you've got a little bit of your personal allowance left, 3712, to take up to your 12,500 limit. You then have the next 2,000 can be taken as tax-free because of your dividend allowance, and then the remaining 35,500 would be taxed at 7.5%. And if you issue dividends, if you issue more than 41,212 in dividends, then you'd be having to pay a higher dividend tax of 32.5% on any of those. And there's a higher level still if you're issuing dividends above 150,000, is it, Michael?
Yes.
Okay, so Okay, so those are the things that because the tax year is very important, you've got to get those in by the 5th of April. As Michael touched on, when you are issuing, when you're doing salary, you have end of tax year salary responsibilities. So as a director, you'll be paying yourself through payroll usually and dividends. For yourself and any employees that you have or other directors who are taking a salary, you must make sure that you file your final full payment submission to HMRCs. That's one of their RTI payroll requirements. It all gets looked after for you in your Crunch software, but the way you deal with it does depend on what salary you actually have set in your Crunch account. And I know that we emailed all our limited company directors over the weekend to explain exactly what they need to do about the FPS thing. Depending on whether you're taking a salary above the threshold or at the threshold or lower than the threshold, there are slightly different things to do to make sure that your final full payment submission goes along with your March payroll. Anything you wanted to add to that, Michael?
The only bit to add on is that those who are taking below the NI threshold would obviously need to factor in whether they need to take a bit more or not. If you want to take more, depending on, you might be having other income, say, let's say rental income or sole trade profits and the rest, it might be best to speak to an accountant, try and work out what extra salary you could take so you fall within the basic rates and the rest. Once you decide that, then that final payroll can be done before you then do your final submission. For some people, they might be having too much income, so they wouldn't want to take any more salary. So again, there's a different path for them as well.
Yeah, and as always with these things, Crunch clients, speak to your client managers. You can get you in touch with an accountant if you need specific one-on-one advice. Otherwise, as we said on this slide here, the recommended salary is usually 8788, but you can of course take more or less than that. It's entirely up to you, but we can offer you advice. And then the only other things that you'll need to do is you'll need to make sure that P60s and P11Ds are issued for yourself and any employees. And again, the deadline for P60, 31st of May, the deadline for P11D, 6th of July. Those will all be produced automatically for you in Crunch as long as you make sure that you're reconciled up to the end of January. Sorry, up to the end of April 21. Okay, so for sole traders, it's a lot less simple for you, but you do still want to make sure that you have logged all your invoices and expenses into your software. That will then show you exactly how you've performed during the tax year. If you're not yet a Crunch sole trader client, there are a couple of ways that you could account for things. So the cash basis of accounting means that you account for any invoices when they're actually paid, and you account for any expenses when you actually make the payment. Whereas the way that most accounting software such as Crunch works is working on an accrual basis. So invoices are accounted for when you actually issue them to the client, and expenses are issued on the date of invoice from a supplier. So for a sole trader, you just do want to make sure that you've got all of your invoices and expenses logged, and then you can actually start thinking about getting ready to prepare for your self-assessment nice and early, which is always the deepest joy, but of course Crunch make it much easier for you with our software. So other things that you need to do before the 5th of April. So this applies to both sole traders or limited companies. The most obvious thing is make sure you have claimed all of your expenses. If you're using Crunch software, then you'll hopefully know already about our free app Snap that lets you take a picture of your receipts and upload them. But even if you don't use Snap, you can still capture a receipt against all your expenses within the Crunch software. And that then makes your life an awful lot easier in terms of keeping receipts and keeping information and not having to wade through shoe boxes or plastic bags full of receipts. We'd also just always remind you, make sure you're claiming everything that you can. Speak to your client managers if you're ever unsure about anything. We've also got our articles in our knowledge section that explain all the things you can claim as a sole trader or a limited company. Simplest rule is it has to be wholly and exclusively for your business. As always, before the 5th of April, make sure you have sent any invoices that need to be recorded so that they get in for the correct tax year. And in terms of keeping your receipts, Crunch does this for you, but if you are keeping manual receipts and anything for your business and you're not using Crunch software yet, then you'd need to keep it 6 years after the end of the accounting period or tax year that they relate to. Anything to add on this slide, Michael?
Yeah, I think the one advice would be that they actually consider things that are not on the company or business bank accounts. Those are the ones that are quite easy to forget. So directors usually pay for business expenses out of their personal bank accounts, and sometimes some forget to claim and the rest. So that's the one that can easily be missed.
Yeah, obviously claiming your expenses is the best way to reduce the amount of tax you pay. So we always want you to claim as many expenses as you can, as long as they're going to be allowable. So do speak to us if you've ever got any questions about that. And then the other thing to say before the end of tax year is obviously don't lose your valuable tax breaks. So each year you get a new ISA limit. The limit's going to stay the same this year, but it means that you could save up to £20,000 in an ISA, a combination of cash ISAs and stocks and shares ISAs, and you don't pay tax on the capital gains in the way that grows. So they can be very tax efficient in that way. And even more important perhaps, pension contributions. So the annual allowance isn't changing again this year, so you can pay up to 40,000 into a pension in any tax year, and the payment will need to be received by your pension provider by the 5th of April for it to be able to count to the 2021 tax year. If you're running a limited company, then usually it's more tax efficient to make pension contributions through your limited company because you don't pay corporation tax on them. But as we've got articles about these things, but with pensions, often you may need specialist advice through a financial advisor. Crunch can put you in touch with our partner, Hargreaves Lansdown, who can offer this sort of advice as well. Michael, anything else to talk about tax breaks and end of tax year?
No, not on this particular slide.
Okay, and when we send the slides out, there's a link on the slide to our Getting Ready for the End of Tax Year article. It's also available in our knowledge section, has all of this information. So we're going to move on now to what are the main tax changes coming in for the 21-22 tax year. So these are effectively all going to be coming in from April. The 6th of April is when the new tax year starts. So the major things that sort of affect everyone are the tax-free personal allowance. So that's going up by £70 to £12,570. The basic rate threshold is also increasing by £270 to £50,270. That means that if you're taking if you're paying income tax, you would pay the 20% basic rate on up to £37,700 of income above your tax-free personal allowance. As we said before, there are different rules for Scottish residents. Those are all in our thresholds article. Other things that are important changes, national insurance, although the rates aren't changing, the thresholds are. So the primary threshold for national insurance is increasing to 9,568. That's the level at which employee national insurance would need to be paid. The secondary threshold for national insurance is increasing to 8,840. That's the level at which employers' national insurance would need to be paid. We'll come on to what that means for salaries on the next slide. If you're a sole trader, the small profits threshold for national insurance increases to 6,515. So that's when you would need to start paying class 2 national insurance. That's right, isn't it? The £3.15 a week. And the lower profits limit is increasing to 9,568. And the upper profits limit increasing to 5270. Have I got those right, Michael? I'm slightly confused as to whether
Yeah.
I've...
For sole traders, the 6,515, that is, sole traders pay 2 types of national insurance contributions. There's class 2 and then there's the class 4. Now, class 2 is mandatory if your profits exceed the 6,515. Below that, it's voluntary, whether you want to pay it or not. Now, we would obviously recommend you pay even if your profits are less than the 6,515, because it counts towards your state pension entitlement. It counts as a qualifying year. So voluntary contributions does help. Then with the lower profits limit, that is, it's above this figure that they start paying the class 4 national insurance contributions. So they don't pay any national insurance contributions class 4 until they start earning above the 9,568. And between that figure to the 50,270, they are paying class 4 national insurance contributions at 9%. And then once it goes above the 50,270, they pay it at 2%. Yeah.
Okay, great. All of our rates are in our thresholds article, which has been updated. We're frantically updating all of our rates and dates articles. So there's about 70 or 80 to do. I think we're about halfway through at the moment. We've done most of the key ones, such as the tax rates and thresholds, how much to pay yourself, national insurance, and things like that. So moving on to the next slide. So we said we'd talk about what that effect that would have for the tax efficient salary for directors. So in the 2021-22 tax year, we've calculated it's still the secondary NI threshold that you want to be targeting, so that you don't have to pay any employers or employees national insurance. And it means that the tax efficient salary for most people who don't have any other sources of income is going to be £8,840 for 21-22. Michael, did you want to cover anything else on this slide?
It's just that the employer's allowance, there's been no indication that that's been changed, so it's still the 4,000 as far as we know.
Yeah, and that's the one that's appropriate if you've got more than one employee on your limited company and you meet the other eligibility criteria. So it means that you can have a £4,000 allowance towards any employer's national insurance you need to pay. So if you're a sole director of a limited company, it's not going to affect you. We've got all of this information in our article on taking a salary from your limited company, and there's a link on there which we'll send around afterwards. So the next thing is what impact that's likely to have on dividends for directors. So there's no change to the £2,000 tax-free dividend allowance. And if you're taking a tax-efficient salary, as we recommended, of 8,840 for the 2021-22 tax year, that means that if you took salary and dividends up to the basic rate threshold, the higher rate threshold, a total of 50,270, it'd be made up of a salary of 8,840 and dividends of up to 4,140. If you took the full amount, you would pay 2,677.50 in income tax. You'd pay about £15 more in tax than you would do if you were taking up to the same threshold in the 2020-21 tax year, but your income would actually have increased by £270. So it's not, the budget was relatively friendly in that respect, even if the amounts aren't spectacular changes. I think one of the important things is that the announcement was also made that these rates are going to freeze Michael, did they say how long they were going to freeze the rates for?
Yes, until 2026.
Right. So effectively what that means is more and more people are going to be drawn into paying either basic rate or higher rate tax because they're freezing both the personal allowance threshold and the basic rate, higher rate border threshold of 50,270. So again, we've got all of our information in our dividends article. Did you want to cover anything else on this slide, Michael?
You were saying that the £15 they pay more is the same income. It's not actually for the same income. It's up to the basic rates threshold. So previously it was 50,000, but now it's 50,270. So it's £15 extra to take income up to the 50,270.
Yeah. Okay. So we had a question in here that's about recommended salary, and it says, if you mean no other sources of income, if you have rental income that's less than £7,500 a year, which is allowed in the rent a room scheme, does this mean I can still aim to pay myself the sole director of a limited company up of 8840? So this is specifically about rental income that is below the rent a room scheme threshold. Is that still classed as income, and does it affect your director's salary?
Yeah, it's still classed as income, but then there's a relief for it. That's rent a room relief. So that's separate from rent a room relief means that the landlord, so in this case, it might be the director or whoever it is resident with a tenant in the same premises, and then they just giving them a room. In that case, there's rent a room relief, which is 7,500. So that kind of wraps out whatever income they've got anyway, so they could still claim the 8840. However,
Okay.
we are talking about a property where the tenants reside by themselves and the landlord lives somewhere entirely different, then they wouldn't be entitled to the rental room relief.
Okay. One other question on that is income from a house or property abroad included as income for taxes?
Yes, if with income from property abroad, it depends on your tax residency. So the tax law is quite simply like this. If you are deemed to be UK tax resident, you are subject to tax on your worldwide income. However, if you are not UK tax resident, you are only subject to tax on your UK income only. So if we are assuming that the questionnaire is basically UK tax resident, then rental from abroad is part of their income, which UK will be taxing or HMRC will be taxing.
Okay, so most crunch clients, I think, tend to be UK tax residents. So that means that it would affect the director's salary. Again, for individual situations, it's definitely worth speaking to our client managers and accountants to get personal advice. This session can only ever give general advice to people. One question on dividends, Michael, that I think is worth asking now. Does the dividend actually have to be paid within the tax year? I thought you could pay it later and backdate it.
That is basically something that's done in the past, but it's something that HMRC kind of frown upon anyway. There's what we call interim dividends and then final dividends. So whenever we are issuing dividends, it's always based on the dividend voucher dates anyway. So the company can declare dividends at any point in time, which basically hits the ledgers in terms of the accounting software. But then the payments can obviously be done later because the payment is usually, don't want to bore listeners too much with accountancy terms, but when we issue dividends, it kind of hits ledgers like a director's loan account and all of that. So it simply means that your director's loan account is going to be in credit, and then you can then draw out the funds later on. So it's a bit complicated when you want to describe accounting and to, let's say, accounting processes to non-accountancy
So it's definitely best practice to issue your dividends before the end of the tax year.
Yes.
Because HMRC can frown on you trying to backdate these things. We would always recommend, because you should be able to work out what you are able to issue. You should raise that dividend in your Crunch software before the end of the tax year, even if you don't actually take it as cash. There was one more quick question on expenses, which I think it might be worth asking now. It's just saying, why is it important to claim expenses before the end of the tax year when they affect corporation tax, and that runs to the company financial year? So it's probably safe to say that there is a slight distinction between whether you're a sole trader or a limited company. If you're a sole trader, you definitely want to be making sure that your expenses are recorded in the right tax year. If you are a limited company, Michael?
If you're a limited company, remember that sometimes the emphasis we are making is based on the individual director who's paying business expenses for the company. And by, let's say, claiming those amounts, let's just take something, for example, like use of home. In some cases, some company directors rent their company or their homes to the companies. In that case, they are basically having rental income from their company. So it is best they actually declare this early and then are able to record that on their self-assessment. That is why the dates is quite important. So from a company point of view, the accounting period might be different from the tax year, but we are looking at it from the individual's point of view in terms of what they are claiming from their limited company.
Mm-hmm. Okay, right. So I mean, it probably also just comes back to the fact that it is always good practice to have your books as up to date as possible. It's one of the advantages of having online accounting software like Crunch, is that it lets you see what your corporation tax liability. It's always a good idea to have the information in your account and for it to be reconciled and up to date. I think there was one additional question on the dividends, just saying, so just to clear up, is it okay to issue dividends in one tax year but not actually have to take the money from the company bank account, i.e. the company could just owe you the money? I think that's exactly what we're saying. It's a good idea to make sure that you do issue the dividends, even if you don't physically take the money out of the account. There was one other question on salary, but I'm going to cover that one later. Actually, no, I'll ask it now. So, Michael, are there any benefits to taking a salary slightly above the secondary threshold, but below the primary threshold, especially in terms of NIC contributions and state pension?
Not really, because in terms of state pension, both the secondary and then the primary will still give you entitlement to state pension. So there is no difference there. The only thing is that you would basically be paying more employers' national insurance contribution. And yeah, that's it.
Okay, yeah. So the reason that we recommend the secondary threshold is because you're already above the threshold for gaining an NI contribution. So we would normally, and again, this is not individual advice, we'd normally recommend not taking a salary above, because as soon as you do, then you have to pay employers' national insurance at 13.8%. So we would say there's not really usually going to be any advantage in that. Last question on dividends. Do you need to pay yourself dividends from your company by the end of the company tax year, not your personal tax year?
No, the payment of dividends is different, okay, to the issuing of dividend. Okay, in terms of the payments, remember that anyone who's familiar with the Crunch software would know that when you're taking money out of the company, it's marked as withdrawals. Now you've got the ability to allocate those withdrawals to dividends you've probably already issued. So payments can be delayed, but in terms of the practical accounting bits, all transactions between a director and then the company is basically recorded in your director's loan account. So when dividends are issued, they hit that director's loan account's ledger, and then when the The director then takes the money out. That also hits it. So, and it's all dated based on whenever the transactions do happen. So payments can be delayed, but as long as your director's loan account is in credit, then you can draw out the payment at any point in time.
Okay, and it's also important at this point to point out dividends have to be taken from company profits. So dividends are taken after corporation tax has been accounted for, but when the tax that you pay on dividends is personal income tax. So that's why we're saying take your dividends from your company that you're allowed to take that are from profits. You need to take those before or record the dividend being issued before the end of the tax year, because it's your personal income that will decide how much tax you pay on those dividends.
Yeah.
Okay. So moving on. Excuse me, I've gone a little bit too far. So another big change that's obviously coming in the budget is going to be around IR35. We've covered IR35 an awful lot before, so this is really only a whistle stop, but the new rules are going to apply to any contractors or limited company owners that work on off payroll for any medium and large size private sector businesses. They already apply if you work for any public sector organisation. So before April, it's the limited company contractor that decides whether the assignment is inside or outside IR35. From the 6th of April, it's going to be the end client or fee payer that needs, well, it's the end client that needs to make this decision. So if they decide that your contract is inside IR35, they or the fee payer will deduct employment taxes from you. So they will need to issue you something called a status determination statement, which will explain the IR35 status, and they'll also need to explain what employment taxes have been deducted on any payments you receive. And effectively, if your assignment is inside IR35, then what that means is HMRC are seeing it really as a contract of that really you're an employee rather than self-employed or working through your limited company. So there's an enormous amount of information on this on our 35 Hub. We've also emailed you all recently links to our most recent article. The one thing I would say is definitely if you are ever unsure about the status of assignment or you disagree with the status that your end client has passed on to you, our R35 Navigator tool is completely free for contractors to use. You answer the questions and it will give you an assessment of whether your assignment should be inside or outside or borderline. And that's free for as many assessments as you want to take. If you're on our premium package, we can also, you get one free detailed assessment of your contract and assignment, because if you disagree and you think you're inside, you are allowed to appeal, and your end client needs to deal with that appeal and get back to you. I think it's within 3 weeks, because obviously it's still within.
I think it's 45 days.
45 days, I'm terribly sorry. It obviously is more expensive if you're deemed as an employee, then you're going to have to pay employment taxes, and that can be difficult. But our Crunch Premium package includes all sorts of IR35 support, as well as the status and contract reviews that we talked about. You can also, if you need to, work through an umbrella company for assignments that are inside IR35, but keep working on assignments that are outside IR35 through your limited company. So you'd pay less tax on the ones that are outside IR35. Anything to add on this slide, Michael?
No.
Okay, so there were, although there were an awful lot of people saying that this was not a great idea, I'm afraid HMRC are proceeding. They did carry out a review at the end of the last tax year. There were some slight changes where they announced that if the end client was based wholly overseas with no UK presence, present, sorry, then the new rules would not apply, and that there'd be a soft landing for the first 12 months, and that HMRC also wouldn't look back to previous years, except where they suspected fraud or criminal behaviour. And it will only apply to services carried out after the 6th of April 2021. And in order to make it easier for limited company contractors to decide whether it's the end client that will be making this decision or not, there's now a legal obligation on any end client to respond to a request for information about their size. Because if they're classed as a small company, then it's still going to be the limited company contractor that decides whether the assignment is inside or outside R35. So it's an area that is really important for you to get right. And please, if you've got any questions about it, do speak to your client managers. The other thing that was announced in the budget that I think is going to have an effect on any limited company or many limited companies, although not until the 6th of April 2023, is that they're planning to freeze corporation tax at the current level of 19% for 2021-22. But they've announced that they're going to then increase the rate for larger companies from 2023. So there'll be a small profits rate of 19%, and that's going to be for businesses who have profits of up to 50,000. But if your business profits are over 50,000, there's going to be a tapered increase up to a main rate of 25% and businesses with profits of over 250,000 would be paying a 25% corporation tax rate rather than the current 19%. That is due to come in from April 2023. There will be a taper for businesses whose profits are between 50,000 and the 250,000 level. They haven't announced exactly what those figures are going to be, and all of this is subject to consultation, but it's always good to be able to plan ahead. And as soon as Crunch will definitely be responding to this consultation, and as soon as what the impact on our clients is clearer, we'll be communicating with you all. Michael, I don't know if there's anything you wanted to add to that at this stage.
No.
Okay, so yeah, I mean, this is just us warning you of something that's likely to come up ahead. It may produce some opportunities for tax planning over the next few years, so we'll make sure that we let you all know about that. Slight change for company cars or vans. So these changes affect sole traders or limited companies. Obviously, if a sole trader can't have a company car because they aren't a company, we usually only recommend claiming full costs for vehicles if it's for a tool of trade. So you're a courier or you are a builder who has to use a van. We wouldn't normally recommend, if it's just to get to and from work or clients, that you actually have a company car or claim the full costs if you're a sole trader, but you can. We would normally recommend that you use business mileage rates. But Michael, did you want to just explain briefly what the impacts were if you are a limited company and you are using a company car?
Yes, if you're using a company car and then you have personal use, we obviously have what we call benefits in kinds, which usually is recorded on your P11D. So they've made a few changes in here in terms of the rates on there. So you've got the vehicle, let's say, value being increased from the 24,500 to 24,600. You've also got the company van also being increased by £10 to 3,500, and that of fuel is now 669. So if you are using company vehicle for personal purposes, these are the kind of rates that will be used when we come to doing your P11D computations.
Okay. Again, all of this information is in our company car article. If any of you are still or having to start repaying student or postgraduate loans, then there are some changes to the threshold at which you need to start paying. Those are there. There's no changes to the thresholds for postgraduate loans, but there are some changes for Plan 1 and 2 loans. Is there a change? Is that a change Plan 4 for
Plan
Scottish
4
students?
is a new one they've introduced. The Scottish minister announced a while back that they wanted to probably have a new rate. So this is the one, and I suspect it's the note on it basically says that it's for existing and new loans. So we suspect that most Scottish students, even if they were on, let's just say, Plan 1 or Plan 2, will probably be moved to Plan 4. In all cases, they will be receiving, or the employers will be receiving notification from I think it's called SAS also, that's the Scottish student loan body anyway, to advise what the plan should be anyway, but that Plan 4 is a new one for Scottish students only.
Okay, so some of the other changes that were announced in the budget: national minimum wage is going to increase. So if you have any employees, you need to bear this in mind. It's going, the headline rate is £8.91 per hour if you're over 23 years old. Our article explains all of the differences between minimum wage and living wage and what you need to think about. The national minimum wage does not usually apply to limited company directors if they're the sole employee, so you don't have to pay yourself at the minimum wage. But if you have any other employees, then you do need to take that into account. Capital gains tax, no changes there. So the annual exempt amount is remaining at 12,300. I think, Michael, they said they were freezing that for the next few years as well, didn't they?
Yes.
One of the big changes, I don't know, Michael, if you wanted to talk a little bit about this super deduction that the Chancellor has announced.
Yes. For those who don't know, we have what we call annual investment allowance that is supposed to end this tax year. Sorry, it's supposed to end by 31st of December this year. Now, they are also introducing the super deduction. Now, with the annual investment allowance, most clients could claim 100% of the value of whatever was purchased. So if you bought a laptop for, let's say, 2,500, the annual investment allowance meant that you could get a tax deduction of the 2,500. Now, the super deduction has been introduced for a period of 2 years, up to 2023, and you will be allowed to claim 130% of the value of whatever you purchase. So this is a new one coming in, and most clients will be entitled to this anyway. So it reduces your corporation tax.
Okay, so this is something that is likely to be of interest to many of our limited company clients. It's limited companies only because it's the corporation tax that it is offset against, and it's been announced so recently that they haven't really given us all of the information yet, but we will be contacting everyone who is a limited company client to make sure that they're aware of it as soon as the more details are available. One thing that's already available and ready to go is the VAT reverse charge in the construction industry. So if you work in the construction industry, you now need to be aware of that, and the crunch system has been updated so that you can account for that correctly when you're doing your invoicing. We talked earlier, didn't we, about the VAT reduction in hospitality. So it's 5% VAT rate for supplies from the hospitality sector. This can obviously affect people who don't work in the hospitality or tourism sector because it affects things like food that might be bought and things like that. So that 5% is going to be maintained up to the 30th of September, and then it's going to rise to a interim rate of 12.5% after the 1st of April 22, and at that point it'll go back to the normal 20% rate. So this is to help the hospitality and tourism section, but it does have an impact on some of our clients. And then one other thing potentially worth mentioning, if anyone is claiming child benefit. There's a £50,000 threshold for something called the higher income child benefit charge, whereby if either of the parents or carers is earning above 50,000, your child benefit amount can get clawed back. That used to be aligned with the higher rate threshold at 50,000, but they have not increased that this year, which means even if you're a basic rate taxpayer, you still may need to be careful that your income, if your income goes over 50,000, you may start to lose some of your child benefit. I think that was the major things that we were going to cover. There were some changes around mortgages as well. So the stamp duty threshold increase is being extended, I think, isn't it, Michael? Is that for another 3 months?
Yes, stamp duty, I think, is up to June. Yes, up to June is still the 500,000 at the nil band rate. Then it drops to 250,000 for July to September. Then it falls down to 125,000 after that period from the 1st of October. On the mortgages, basically 95% mortgages they've introduced at the moment.
Okay, yeah. So there's some sort of further support from the government, but they're helping to try and get more people onto the property ladder by making sure that there are mortgages available with only a 5% deposit. Okay, that is pretty much all of the content we had for you, and we've just about managed to fit it in within the hour. Just to remind you, there's always information in our Crunch Help Centre and in our Crunch Knowledge articles. If you're a Crunch client, you of course have access to our client managers who can help you, and we always try to make sure that we send out the information that you need via email. So I think the next thing is for any questions that we haven't covered yet. So there was a question about pension contributions, saying whilst you can contribute £40,000 in a tax year, could you pay more in a company year, i.e. if the company year doesn't match up with the tax year from April to April? So I think there's a couple of answers here, aren't there, Michael? One thing, the 40,000 is what you can pay in any one tax year, but there are things like carry back available. So if you haven't paid 40,000 in each tax year for the last 3 or 4 years, you are able to use some previously unused allowances. I think that's called carry back, isn't it, Michael?
Yes.
So that can allow you to pay more than 40,000.
Yes.
The question about how it interacts with your company year, one thing that it is important, if you're paying through your limited company, it's important that any pension payments you make are not greater than those company profits.
Yes.
I don't know if there's anything else you wanted to add to that question. Obviously, we aren't licensed to give individual pension advice, but in terms of how it affects your tax, anything else you wanted to add to that, Michael?
No. As long as there are enough profits, or let's say enough revenue to cover the pensions, then payments is basically fine. So you can pay, let's say, 120,000 in a company year to cover, let's say, previous tax years anyway. But you obviously need to speak to financial advisors before you go ahead doing something like that.
Yep. Okay. Another question on IR35, Michael. So I have a contract that's inside IR35, and as a result, I need to work through an umbrella company. What should I do with my limited in the meantime? So, I mean, I think there's a few answers to this question. We're very happy to speak to you individually on these situations. If you've got multiple contracts and some of them are inside and some of them are outside, or your contract that's inside is only short term and you're likely to go back, then we'd strongly recommend our premium package, because that allows you to switch effortlessly between them. So monthly payroll, sorry, not monthly payroll, monthly umbrella is included within your subscription, and you can just switch between them. Is there anything else you wanted to add to that, Michael?
Yeah, in terms of what is done with the company will technically be dormant whilst, let's say, you are working through the umbrella. So again, you could probably have company not trading for X number of months, and then once you're done, the company then starts trading normally as well.
So we
your client.
Yeah, I think we definitely would recommend you speak to a client manager on these. We offer a number of solutions on these. Either, as we said, our premium package that includes umbrella and limited company, and that's perfect if you're going to be carrying on some limited company work and some umbrella work. Obviously, you then have the option of making a company dormant as well. That all of that type of information is all in our R35 hub, and we had a link to that earlier in the slides. We'll definitely be uploading the slides and sending them out to everyone afterwards. I think we've just about we've overrun by a couple of minutes. There's a few questions we haven't yet managed to answer. I think I might be able to fit just one in, which said, if I'm a sole trader using Crunch Free, how do I record expenses for my own training? Michael?
I think that is basically being looked at the moment. We initially had what we call a staff training in there, but obviously sole traders are one-man bands and the rest, they have no staff. So the developers are looking at how they include training in there without actually it sounding a bit strange.
So sole traders are able to claim for their own training, are they, Michael?
Yes, training expenses are allowable if they are to enhance existing skills. So imagine that someone is an accountant and then they probably wanted to get a higher qualification accountancy, they could claim that cost. However, if you wanted to probably get training in something that was non-related to the business, like catering and the rest, then that is basically not an allowable cost. So sole traders are entitled to claim training as well. The problem we basically had was that the word staff next to the training meant or gave the perception that you have to have employees, which was something that was basically taken out, but they are working on how to include that in.
Okay. I think that is pretty much all of the time we've got at the moment. If there's questions that haven't been answered yet, I'll make sure that we do get back to people with an answer specifically about what they should use to record their training as well. We'll make sure we get back to you as soon as we can. But otherwise, I'd just like to say thank you very much to Michael for being with us and giving us your expertise today. Thank you very much for everyone who's attended. We'll definitely be emailing all the people that have registered to send you the slides and to give you the questions and answers that have been asked through this. So good luck getting ready for the end of the tax year, and thank you very much for your time today.